Welcome back to Global Money Talk, brought to you by SamProTV. We're live from the New York Stock Exchange this morning, and we'll be taking a look at technical analysis, which is a method of analyzing securities that utilizes price as well as volume data, usually shown in charts. And these charts are analyzed with different indicators to make investment recommendations, and it's also been used by traders and investors and widely expected by regulators as well as academics. Now, while technical analysis does follow specific rules, interpreting the results can be subjective. Well, joining me today again is Tai Wong, independent proprietary trader, and he will dive into technical analysis with us. So Tai, welcome back again.
Good to be here again.
Yes, well, we had a quick break and we're here to do a deep dive into technical analysis. So when we're talking about analyzing securities or what's happening in terms of individual stock names, we have fundamental analysis as well as technical analysis. So what is technical analysis?
So technical analysis, and I'm going to say to our viewers, there can be a lot of charts this time because we really can't do technical analysis without charts. But if you have questions, put them in the comments, contact us. We try to do our best to maybe either have another presentation on it or to answer the question. So go back, look at it, pause after it comes out. Absolutely free to do that. So in terms of the technical analysis, it's worth talking about the theory behind it, because there are some folks who say, this technical analysis stuff, it's garbage. We only believe in sales and earnings and all the the hard stuff. The idea behind technical analysis is if you assume sort of, I guess, an efficient market, right? There are some really smart people who are looking at all of those things, the analysts who tell the traders what to do and the investors who listen to the analysts. The idea is that all the information that is in the market is actually in the price. And this assumes that it's a free market and there's a free flow of information. There's not a lot of insider trading, which I think in many sort of open capital markets that is true. All the a great bulk of the information is up there. So technical analysis is trying to basically look at a stock, commodity, an index, pretty much anything that trades based on its price movement and volume and momentum. And I remember the first time I saw this back in 1991 when I started in the business. There were folks who would actually physically use graph paper and chart the movements of certain things. I remember one person, one trader, he traded I want to say he traded Mark Spain, which was a Deutschmark Spanish peseta cross, which hasn't existed since 1999, right? I don't expect you to remember that at all, but he would chart that by hand. But now the technology is so good, whether it's Bloomberg, whether it's TradingView, which is free, which is an awesome platform, you can flip back and look at any chart. And that's really important because, I mean, the easy thing about technical analysis, it's just basically looking at charts and figuring out what is going to come next. And you can look at a lot of different charts. Now, why is sort of this chart reading? What's really behind it? Well, what it's trying to do in microcosm is to understand psychology, human psychology. So to understand what's behind technical analysis, it really is what a story is it telling you. So let's go to graphic number 2, and is technical analysis legitimate? I think it's completely legitimate versus the fundamental analysis we talked about, or a random walk, which says things just sort of move randomly and they largely mean revert. Yep, that's true in a market that's sideways. But if you tried that mean reversion trade in S&P 500 or in gold, you'd have a real tough time this year. So what's important is a lot of market participants, I would say a great majority, look at it. So investors and speculators need to understand it. What I would also emphasize is that you should not use it in isolation. You shouldn't look at a chart and says, oh, I see this, this formation. It's definitely a buy. You've really got to understand context and sometimes even the seasonality of certain things. But context is really, really important. And for me, I can't remember the last time I made a trade, whether it's to buy or to sell or even to hold, without looking at a chart. So let's move to graphic number 3, because there are sort of different kinds of charts, and it's important to talk about that. So, and I do apologize because I couldn't get them to be as visible and as legible as I'd like. But the things that you often see is you often see a line chart, which is on the far left, which is what we often show when we show the intraday movements. Then there's a bar chart. Again, I apologize, it's hard to see. And then there's a candle chart. So my view is you must always use candle charts. Line charts are useful when you're basically comparing something, two charts together where there's too much noise when you use a candle. You can overlay line charts, and they're useful for comparisons. But otherwise, there's the story behind a line chart is like reading the abridged edition of a book. You don't really get, you sort of get the idea, but you don't really get how really good and how great it is. So let's move on to sort of the candle chart. So we'll spend a lot of time on that. If we could have graphic 4, please. So this is, these are candle charts, and it's a candlestick chart. It was actually developed by a Japanese rice merchant named Munehisa Hama. I hope I pronounced that right, Remy. Did I get that sort of okay?
You did.
Okay, in the 18th century. And this man was really, really successful. Some people say that he, because he could trade the rice market so well, and it's such an amazing network, that he was a billionaire in today's dollars back in 18th century Japan. So let's talk a little bit about the candlesticks, because for me, I look at it and I say it's second nature to me. So the candles are important. That let's look at the left candle, which is, which signals an up day. The top of the candle is the high of the day. The bottom is the low of the day. The bottom of that body, where the green column is where it opened, and the top of that green column is where it closed. So as soon as I see that, I know what happened that day. I know the range. I know whether it closed near the highs or closed near the lows. Now, on the right-hand side, you're looking at this exact same candle, but it's a down candle. The only difference is at the top of the column, when it's red, means it opened there, and the bottom of the column is the close. Now, it may take you a little time to get used to that, but once you're used to it, and sometimes they do shadow, an empty candle versus a full candle, but red and green, if you're not sort of colorblind, is the best way to do it, is instantly what happened with with the candles. And this, I think, is understanding this is the arithmetic of technical analysis. Once you get this, you take a look and what's happened that day, what's happened that week. So moving on, let's go to slide 6, because one thing we talk about is what chart do I look at, right? And I think we need. Did I say? I'm sorry, number 5. If you can. What chart should I look at? Should I look at the 1-minute chart, the 1-day chart, or the 1-week chart? And in the old days, when my colleague was actually physically drawing the charts, it's a lot harder to see. Now it's one click on the button, 1 month, 1 day, 1 year. So the 1-day charts, which are typically minute bars, and that you can't really see it so closely, is specifically, I think, useful for day traders who are trying to scalp as much as they can in and out during the day. Market makers. So if I'm looking, I would be a gold market maker, and someone would say, "Tai, where are you in 50,000 ounces of gold?" And I'd have to show a bid and an offer. I don't know which side the customer wants to trade. Now, depending on who the customer is, I might be able to guess, but I might not. So I'll have to look how do I'm not going to sit with 50,000 ounces of gold. That's a really big position. So I'm going to have to decide if I had to hedge it, which is the weak side of the market. And I actually have this chart running on my desktop the whole time, and I'd look at it constantly, thousands of times a day. So that's good for market makers. Programs will actually don't look at a chart, but they certainly have the data behind it. Now, for short to medium term traders, you want to look at the 1 year chart, which is each bar is a day, and it's a trading day, and that tells you what's happened over the past year. You can look at and it gives you sort of better perspective. And on the note of perspective, on the right side of that is a 5-year chart, and they're the weekly bars, right? And it allows you to sort of step back, get better perspective. What has this thing done since the pandemic? And if you were really curious, you can actually go to 10 years or max and see what it's done for the last 30 years. But what's important is as an investor, you want to look at all of them. You want to see what the long-term trend is. That's the 5-10 year trend. What's happened so far this year, and then you can sort of decide if you're in it longer term and you like this. Really probably isn't that important if you buy the bottom tick. Very often if I decide I like something, I will just go to market with it. Buy at best, sell at best, because the last thing you want to do, if you have a great idea and the market is trading 98, 99 bid offer, just as an example, I like the stock, I'm going to bid at 98 and a half. Well, what if it goes 99 gets paid and it keeps going and you've missed it, right? The markets are so efficient now, thanks to places like Schwab, which basically charges no fee for trading. They're so efficient, the spreads are so tight. If you like it, just buy it. Don't mess around with buying an offer. That's for the programs. That's how they make their money. More power to them. They do that thousands of times to make a sliver on each trade. And as a matter of fact, why is it free for us? It's because that Senator Warren, I think she gets this because I think she's a real smart lady, but she has a platform she stands on. The Citadels of the world, the Virtus of the world, who do the market making, they will actually pay Schwab to send my order to them so they can make a tiny sliver, a penny or two. They do it thousands, tens of thousands of times a day, and that's how they make their money. So it's great for us. What I'm saying is, if you like something or you don't like something, just go to market. Don't bid an offer. That's not the game that investors are really, I think, going to win at. I like to look at, I mostly look at daily charts. The one thing I do look at the minute charts is when there's a piece of data out, and I don't want to wait like 3 or 4 seconds to see what the data was. I just look at gold, and gold will tell me what the data was because the machines are so fast. So, any thoughts? I've gone through a lot of stuff.
I think you've given us a great overview in terms of the time frames, the type of charts that are out there, and you've given us a great history lesson as well when it comes to technical analysis. And I think you've addressed the question of legitimacy, because when it comes to any type of analysis, whether we're talking about technical or fundamental analysis, that's the question. How legitimate is it? How accurate is it? And how can we apply this as investors or retail traders out there? And I think when it comes to graph paper, that brings me back to childhood. And, that's very nostalgic when I come across graph paper in a stationery store, because it's akin to finding a compass or some instrument, whether it might be an abacus, because there are still parts of the world where people still actually have that instrument, the abacus, to do their simple accounting.
My mother had one, and she used it, and she taught me how to use it. I still have it. She's gone a few years now. I don't think I remember it, but it really, it's an abacus. It's 60 years old, and she used it. She would calculate with it, calculate her paycheck, because she worked in a sewing factory, and how many pieces she made, and how many cents per piece that she made. So, but what's really important is it is legitimate, and even if you don't believe that it tells you much about psychology, and we'll get into that in the next couple of slides. a lot of people look at it. So if the world is looking at it, you need to know what the world is thinking. You also need to know when people write up and say, it's at a 50% retracement, or it's the top of a third wave. You can really get into the weeds in technical analysis, and people do. What we're here today is just to discuss it, to talk about some of the basic things. So for people who may not know it, you get a better sense, and you can do more exploration of your own. So let's move along to the next chart. This is chart 6. And here's what we're talking about, candle patterns and how, in my view, they tell a story. So on the left-hand side is sort of some of these examples, and they all have interesting names. And I think these names have been anglicized. I think originally, it was Mr. Hama in Japan who came up with these things. He had probably different names for it, but it's a little tough for Westerners, so we've changed it in things that we can understand. But I bet doji is probably a Japanese. Doji a Japanese term? It is? What does it mean in Japan?
Oh, well, I'm not quite sure what it means, but as you mentioned, Tai, when it comes to some of the names or the terminology for these candle patterns, if you can read these Chinese characters, it's more intuitive to understand what they stand for. The terms for example, whether we're talking about the hammer or the hanging man, if you look at the actual characters, it's more representative of these patterns. And
I see.
As you mentioned, Tai, when you look at these candlestick charts, I'm sure it's so intuitive that you don't even have to think about what it represents. And hopefully, if you can see red and green and you're not colorblind, for example, then the bearish versus bullish. So these candlesticks do represent different patterns. So if you could explain that to the audience.
So let's talk about these. So hammers, literally, they have a small body and long shadow. So if you look at the upper left pattern, that's a hammer. Dojis have long shadows and almost no body. And what I mean, so a hammer says the range was a decent size, but the close and the open were not too far apart, right? And that might suggest that the market has a certain opinion. A doji, and I love that. I remember somebody asked, "What is a doji? Why is it called a doji?" I said, "I don't know, but it's cool." A doji says it had a big range, but it closed and opened in exactly the same area. Basically, there was the opinion might have fluctuated, but it actually came back to where it was. And these are actually very powerful candles because they tell, in my view, they tell a story. Now, remember, I highlighted that surrounding candles are very important. Let's look at the middle two patterns. One is an inverted hammer, and the other is a shooting star. I prefer to use the same term, just me, but they're basically in shape they're the same thing, but they tell a very, very different story. So on the top, that inverted hammer is very bullish because it's come at the end of a downtrend, and it says the market finished higher on the day, and is often likely to be followed by higher candles or higher price action later on. The shooting star, or as I think about it, an inverted hammer, at the end of an uptrend, it was a really good story because it says it opened, sort of, at a certain level. It went up to new highs, right? Because that's the top of the shadow, and then it fell and closed at the lows. So that suggests a change in psychology. At the end of an uptrend. At the end of an uptrend, that is a big warning sign and suggests that the next candles could really be downward price action. That it tried higher and it failed and it closed below the open. Now, if you look at the right, probably my favorite, I always like writing about it, is the gravestone doji. Right? It had a big shadow. It opened at the lows, rallied up to the highs, and then closed back at the lows. At the end of an uptrend, that's hence gravestone doji. And I guess the kanji, maybe that was it has something to do with that. But the dragonfly doji, which is the mirror image, it tells a different story, the opposite story. At the end of a downtrend, it tried much lower, and then it came and finished unchanged. It goes directly to a mentality change, and it'll take a little while for you to get used to that, but once you get used to it, you can say, wow, that's an interesting story. Now, it is not infallible, right? It is not infallible, but it tells a story, and I think if you understand the story behind it, that's why technical analysis, for me, is fascinating and very, very interesting.
And Tai, before we move away from this, I wanted to double check to make sure that we got the right Chinese character or the kanji for doji, because do, the first part of it, it means the same or at the same time, and ji, it could be thing or time. So I just wanted to make sure that it wasn't the kanji combination for at the same time. It's actually the same thing. Okay. Yes.
Right. It makes a lot of sense. Yes. And it's cool. Doji. Everybody can remember that. And I love one of my favorite terms. So let's go to a couple more patterns I want to go into. Let's go to graphic number 7. So these are the bullish and bearish engulfing patterns are really important, and you can see them. You see them kind of a fair amount. So on the left-hand side, you can see the middle bullish engulfing, bearish engulfing. And what that means is, that red candle on the top says, yesterday was a down day, but today we opened lower, tried lower. That's the lower shadow. Then we rallied up and closed near the highs. So that's a turn in sentiment. And the range today was bigger than yesterday, and it's a change. It's bullish. We call them sometimes outside days. And then the opposite is a bearish engulfing day, where yesterday was an up day, but today tried higher, finished lower, and it's a down day. Something must have changed in the thinking. So that's really also a powerful candle. Now, not infallible once again, because maybe some news came out, and maybe let's say Nvidia got a bearish engulfing candle because that ASML news came out, and something else dragging on it. Or bullish, maybe today the TSMC came and bailed everybody out with their Superman cape. So you can't say that I'm going to bet the house on this, but it suggests a change of sentiment and possibly a change in direction. That's why it's so powerful. And I just put in the middle there because I had a little white space. A bar like Marubozo, which is a positive one, is it opened at the bottom and closed at the top, where a red one is it opened at the top and closed at the bottom. There's the doji again. And there are other ones that are not quite dojis, but if they have a little bit of high-low difference, it's called a spinning top. And spinning tops generally you're indecisive. You're big range, but you actually close to where you opened, and you're not really sure. And then that brings us over to the right side. And they have these funny terms like stars and babies. But let's just look at the structures on the right side, the bullish abandoned baby. So that tells an interesting story as well. You have a down day, that red column, and then at the bottom it actually opened. It opened down, tried lower, but finished positively. And it says, oh, why did it happen? And then if the next day you get a big jump, that means that day where it opened lower, tried lower, but finished positive, suggested again a turn in sentiment. So you're really looking to tell these are looking to tell turns. And similarly, at the very bottom, you have the bearish abandoned baby, where it was an up day, it tried higher, finished lower, and the next day it went down more. And so these terms are, and they're sort of interesting to remember, right? It's an abandoned baby. It's sort of hanging out there. Nobody wants it. Kind of sad, but it does give you a picture mentally of some of these patterns, and that's why I think technical analysis is the best when it tells us when the trend is going to turn. Now, I don't have a chart on this because I didn't want to go a little bit crazy. But the other thing that's worthwhile is looking at the volume on up and down days. So if we looked at, say, ASML the other day when it collapsed, the volume was in the sky. So generally speaking, people say if you're rallying on strong volume, that's a good rally. But if you're rallying and the volumes diverge or the volumes are going down, they call that sort of momentum divergence. Like the prices are going up, but it's actually on pretty low volume. So the rally is shaky. And the opposite is also true. So if it's going down and volumes are high, that might suggest that a market that's very long, as it goes down, the longs are panicking and selling. So you want to look at volumes as well. It's usually a bar that it's a bar chart at the bottom of most charts that you can add on. It's something to keep an eye on. Again, not always infallible, but volume is very important. And sometimes we call it breadth, right? Yeah. Rallied on strong breadth. It rallied wide and volume was high. One thing I'd like to get to, and look like I've been prattling on, and I want to get through everything. Let's go to graphic number 8 and talk about moving averages. The moving average is very basic. The simple moving average, which I've shown here on an NVIDIA chart, is the average of certain prices over a period of time. The most common ones are 50 days, 100 days, and 200 days. The 50-day moving average is the short sort of moving average. So it tells you, what's happening short term. The 100-day is a little bit longer. The 200-day is considered long term. And those, if price action is generally above its moving average, which has generally been true with NVIDIA, it says interpreters will say that this stock or this commodity or this index is in a bull market. It's continuing to move higher, because if it starts moving lower, then it suggests that below their moving averages. That means the price action today is below the average of what has been in whatever period of time. So, and then I think actually the bottom is, I have it in this case, is the volume in terms of what NVIDIA traded on those days. So moving averages are important, powerful, but you have to be very careful with them. So let's move to graphic number 9. I'll talk about some of the pitfalls of moving averages. They're certainly the basis of a lot of different studies, as I mentioned there. Now, you hear this all the time. When the 50-day moving average crosses the 200-day moving average, it's the golden cross. Everything's going to be awesome, and it's time to buy. On the other hand, if the 50 short-term moving average goes below the 200-day moving average, they call it the death cross. Prices going down, and you've got to sell. Be really, really careful about that. Historically, that has been, I think, at least the things that I've traded, a little problematic. Okay. So, context. Don't simply trade on it's a golden cross, it's a death cross. Journalists and people and myself love to write about that, because sometimes we have to have something to talk about and write about, and you will always mention this, but be very careful with it. It is also very commodity and security specific. There's some things that trend very well, in which case moving averages are worthwhile, but there's some things that can trade back and forth, very volatile, things like silver. I'd be very careful about, because if you follow these moving averages, they can really chop you up pretty badly. So you hear about it a lot. Be very careful. Know what it is, but be very careful about it. Let's move to graphic number 9, because I want to get everything in. So other things that you hear about, the Fibonacci retracement, and that's based on this scientific ratio, maybe called the golden ratio, and it's about retracement. So they measure the low and the high of a certain period, and they say, oh, well, according to nature, these things are like magic. The most important ones are it's the 38.2% retracement. It should be support there. A 50% retracement. Oh my goodness, it broke through the 61.8. It's going down. There is some element of truth to that, because if enough people look at it, they will trade on it, and therefore it does become sort of support and resistance. It's a little mystical to me. I know it's scientifically good in nature, and maybe our psychology is based on that, but it's sort of mystical. I look at it because other people look at it, but I don't really trust it. Then we move to Elliot wave, and there are Elliot wave adherents, and if Fibonacci is mystical, I mean, they're religious. The religiosity in Elliot wave is amazing. This is the third wave. It's the biggest wave. It's just a retracement of the third wave. It's the A correction. It's the B correction. And after a while, you're like, and the thing with Elliot wave technicians, they so truly believe in it, is, the Elliot wave is never wrong. I've just read it differently. So if it works for you, and by all means, use it. But it's just, there's too much for me. I really just don't follow Elliott wave much at all. But there are people who do it, and I'm not going to, if you like it, it works for you, please do. The Mark Analytics is a guy who, very successful. It's a moving average calculation. It's so good that Bloomberg bought the rights to it, and you have to, if you pay $2,300 a month for Bloomberg, or $3,000 if you're a single user, you can get access to that. And it's based on momentum, whether it's buy or sell signals. Good in a trend, very dangerous in a ranging market. Moving along, let's go to slide number 10 because I'm running short on time. So, some final thoughts on this. I think technical analysis, their efficacy has changed over the last 10 or 15 years, in large part because the machines dominate trading in everything, 80-90% of trading. So in the old days, they would ask me for 50,000 ounces of gold. They don't really do that anymore. They just stick it into a program, and the programmer could do it in 100-ounce chunks or 500-ounce chunks. Machines have no feeling. They don't care that the market's dropping or the market's rallying. So at least in the short term, there's a lot less psychology and emotion involved. So be a little more careful about it when you're using that in the short term. In the long term, people program machines and it matters. But in the short term, be very, I think it's less efficient than it used to be. So sorry to be, to have rushed it, and we needed a little more time.
Well, perhaps in another episode we can do a deeper dive on these individual sections, because we were able to cover a lot of ground, but as you mentioned, technical analysis does involve a lot of moving parts. So Tai, thank you so much for joining me for Market Briefing as well as Market Insight.
Thank you so much for putting up with me talking nonstop for a half an hour.
It's been a pleasure, Tai. Thank you so much.
Thank you.
And that will do it for Global Money Talk live from the New York Stock Exchange. We're so excited to bring you daily coverage here on Sampro TV. You can also check out the show anytime on our YouTube channel by searching Global Money Talk. Thank you so much for joining us today, and we'll be back bright and early tomorrow. Have a great day.